Should you contribute pre-tax or Roth when it comes to retirement? I mean, that is the quintessential financial planning question, or one of them. You got to consider all 6 areas of your financial life to answer that question. I'll get into that. But my question today is there ever a time when you'd actually contribute to both? There actually is. I'll tell you coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So several years ago, my wife is at her employer, and they had a lunch seminar put on by the bank that has their 401k. And during that presentation, there was one thing that stood out to my wife. She doesn't love finances. In fact, I talk about mutual funds or life insurance or finances anytime she wakes me up and says, honey, I can't sleep. Can you help me fall asleep? And that makes her really tired. She falls asleep instantly. But there was one thing that stood out to her. She came home and she told me, hey, I don't really know about all of this, but someone asked a question, should I contribute pre-tax and Roth? And the representative said, no, that's stupid. You should never contribute both pre-tax or Roth. No one would ever want to do that. And I just had a grin on my face. And number one, to say any question or anything like that is stupid, that is just financial shaming. You don't do that. Let's encourage, right? But then second, wrong. Okay? That there are circumstances when you'd want to contribute both pre-tax and Roth. Now, I mean, you've got to decide which one of those makes the most sense, or deciding whether to do both. This is a financial planning question. You've got to consider all 6 areas of your financial life. Your cash flow, obviously, protection planning, maybe not so much, okay? But your tax planning for sure, your investment strategy for sure, your retirement plan for sure, and your estate plan, absolutely. It's all 5 of those 6 for sure are impacted by this decision. And yet so many people just say, Roth, pre-tax, right? Autopilot, or I don't understand. Now, make an intentional planning decision here. I would argue there's 3 reasons. There's 3 reasons. This is not common, but there's 3 reasons where you should consider contributing both pre-tax and Roth. In fact, guys, I've been doing it. I have been doing it. Up until just a couple years ago, I have been doing both, which is very interesting that this individual, this bank representative said, that's stupid. Okay. Let's talk about those reasons. The very first reason why you'd contribute both pre-tax and Roth, this is the most common. And this is the one, those of you that are very aggressive towards saving up for retirement have either good income or do a great job managing your expenses, and you have enough income or whatever, you're aware of your tax situation that you contribute enough to max out your contributions to your 401k. All right? So you do that pre-tax. And then you still have resources you want to save up for retirement. And because maybe you make too much to make a tax deductible contribution to an IRA, you contribute the maximum amount to the Roth. So the first example why you'd want to contribute to both is you max your pre-tax 401k contribution, or pre-tax 403b contribution, or pre-tax simple IRA contribution. You max that out, do as much as you can, and say, I'm still wanting to save for retirement, and I want to do so in a tax-sheltered way. I can't fund anything else pre-tax, therefore I'm going to max out my Roth contribution. Happens all the time. And again, why would you do this? Well, if you have good income, if you have high income, you want the tax deduction today, right? But then you want to also get as much other tax sheltering as you can so you contribute to the Roth as well. Right? So that's the one reason. The second reason, though, is if you do a great job managing your expenses and you can say, listen, in retirement, I don't need a lot to live. I don't know what tax rates are going to be in the future, but we really only spend $3,000 a month. I don't need a lot to live in retirement. Therefore, when I'm spending $3,000 a month, I'm not going to have to pay much taxes at all. Therefore, let's get my tax deductions now because I don't think I'm going to have to pay a lot of taxes in the future. Right? So if that's you, even if your income's more modest, $60,000, $70,000, $80,000, for your household, you might say, yeah, I can contribute the max to my 401k and live on what's left. Therefore, I'm not going to pay much taxes in the future. Let's get my tax benefit now. So that's the first reason why you'd want to consider doing both pre-tax and Roth. Max out your pre-tax 401k or pre-tax retirement plan at work, and then max your Roth IRA contribution, ideally yours and your spouse's if you're married. Work with your CFP on that. The second reason you would definitely want to contribute both pre-tax and Roth is the one that I love, okay? If the first one was the most common, this is the one that gets me really juiced up. And that is you're trying to get your adjusted gross income below a certain threshold, okay? And so what you do is, because your retirement contributions, both to your employer-provided plan and to your IRA, those are above the line deductions, meaning they reduce your adjusted gross income. This is one of the special ways in which you could move your adjusted gross income lower, your AGI lower. Why would you want to do that? Why do we care about that? Because that is what your adjusted gross income is used to calculate a whole bunch of other things. What about all these stinking stimulus payments? Presto, right? If we had known about those in advance, you could have done okay, I'm going to shift. Instead of doing Roth, I'm going to do pre-tax to get my adjusted gross income below a limit. Now I qualify for more stimulus. But let's just assume that's once in a lifetime sort of thing, or once every single recession. I digress. The big one to me is, what about reducing your adjusted gross income so that you qualify for more retirement savers tax credit, my favorite tax deduction? If your adjusted gross income is above $66,000, in that range for a married couple, you don't get any of this credit. If it's below $66,000, then you could get a significant credit. And the farther it goes below 66, that credit can increase a lot. And so if you look and say, well, geez, I'm only making 66 grand. This is, I should be doing Roth. I'm in a low tax bracket. But if say your income 67,000, doing just over 1,000 into a pre-tax IRA or a 401k to get your adjusted gross income below that threshold, and then the rest of it Roth, now you are eligible for that tax credit. Now you're eligible for the retirement savers tax credit. Same thing applies for repaying your premium tax credit. If you are on health insurance on healthcare.gov and your income's below a certain threshold, you get premium tax credits. You get tax credits in advance that reduce your monthly premium that you pay for your health insurance. Well, if your income at the end of the year is too high, whammo, you got to pay all those tax credits back. Contributing pre-tax just enough to get your adjusted gross income below that threshold, and then the rest of your retirement savings go Roth, that's a huge benefit. Same thing for American Opportunity Credit, for college credits. All sorts of reasons why you might want to make sure that your adjusted gross income is below a certain threshold, and then everything after that contribute Roth. Therefore, contribute whatever. This is proactive tax planning. Proactive meaning you're aware of this opportunity all along and making adjustments all along, and then you get your tax return done, but you don't sign it. You get your tax return done, you meet with your certified financial planner saying, hey, are we close? Is there anything we should do? And then at the last minute, they can say, no, yeah, you're good, let's file. Or no, we need to add another $500 of IRA contribution to get your adjusted gross income below this threshold. All of a sudden, it makes this tax benefit. So that's my favorite reason. That's the obvious reason to, why I would tell this bank advisor, dude, don't call anyone stupid for suggesting that. And this makes a lot of sense in certain cases. So contributing pre-tax to get your adjusted gross income or AGI below a certain threshold, and then doing Roth contributions the rest of the way. And then the third and final reason that I can think of right now, just off the top of my head, about why you'd want to contribute both pre-tax and Roth is, if you've been saving pre-tax all along, and you sit down with your certified financial planner or whatever, have the epiphany, you wake up in a cold sweat at the middle of the night and you're like, I gotta save Roth. No one does that. But if you're contributing everything pre-tax and you realize, no, it's time to switch and do everything Roth, that switch, depending on how much you're contributing to retirement, can be a huge cash flow adjustment. A huge cash flow adjustment. Imagine maxing out your contributions, $19,500 pre-tax. What tax deduction does that give you? If you're in the 22% tax bracket, I don't know, saves you $5,000 or close to it, okay? Well, if you now say, I want to do Roth, and stop everything pre-tax and do 100% Roth, now you've got to pay an extra $5,000 of taxes. And if your cash flow, if that wouldn't make it prohibitive for you to make that one foul swoop change, everything pre-tax, everything Roth, if it would do damage on your cash flow where you couldn't make your other goals, you couldn't, I mean, to me, $5,000, this is a lot of money. And if that means, well, I was maximizing my contribution, but now I won't be able to afford maximizing my contribution, maybe you do it in stages. Maybe you do it in stages where you're all pre-tax and then you go 75% pre-tax, 25 Roth. Next year you do 50-50. Next year you flip it 25-75, and then the final year you're 100% Roth. That's a way to smooth out and manage that cash flow adjustment. Did I mention this decision impacts all 6 areas of your financial life? I mean, this is where it impacts your present financial position. If you're contributing pre-tax, you're getting a tax benefit as you're contributing to your 401k, so you have less taxes withheld. When you switch that to contribute Roth, you're gonna have more taxes withheld, meaning your take home is gonna be less, meaning that could adjust or impact your cash flow situation. So if you decide, I'm all pre-tax right now, I need to shift to all Roth, you need to look at your budget and say, can I afford to do that in one foul swoop, or do I need to do that in stages over the next couple of years? That, when you're in that land in between, when you're transitioning, you may want to do both pre-tax and Roth. What's the best one for you? Should you do all pre-tax? Should you do all Roth? Should you do a blend? I don't care. It doesn't matter. There isn't one that's good, one that's bad. But the great one, okay, is the one that brings synergy to all 6 areas of your financial life, brings harmony to your cash flow protection plan, tax plan, investment plan, retirement plan, and estate plan. That's the one that matters, okay? That's the job of your certified financial planner. That's their job. They are supposed to look at all 6 areas of your financial life and say, based on everything here, here's how pre-tax works, here's how Roth works, here's what I'd suggest in your situation because of this benefit. They're supposed to teach all of that to you and then say, here's my recommendation, where you say, yeah, obviously, yeah, that makes sense. If your CFP is not doing that for you, contact one on my team. You can find us online, corehorn.com. That's Corehorn with K, wisemoneyshow.com. You can find us there too, or just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.